Okay, so in section 3, we are talking about using the periodic method. Remember, perpetual method is good, but needs a software. Perpetual method is good because it gets updated inventory at any given moment, updated cost of goods sold at any given moment. So inventory gets adjusted at any given moment. So it's very good, but you need a software. So if you don't have the software, then what is the option? Then the only option left is doing periodic. So periodic method, that means periodically, that means end of the accounting period, you need to figure out what is ending inventory, and using that information, calculate your cost of goods sold, and then recognize it, and then update your inventory. So the inventory T account is never updated under periodic method. It still shows what was last December. Okay, so January 1st balance is technically the December 31st balance that is showing in your inventory T account. And you don't touch it, you don't add anything to it, you don't deduct anything from it until end of the period, which you need to figure out what is the updated inventory balance on December 31st again. Okay, so inventory T account is left alone, is not getting updated periodic at any given moment. It will only get updated periodically at the end of the accounting cycle. Okay. How about cost of goods sold? Under periodic method, cost of goods sold is blank, literally. So it's not showing any cost of goods sold whatsoever. So if in the middle of the, let's say, month, you call me and say, how much is the cost of goods sold T account showing? Nothing, zero. So we need to just update those at the end. But how about if we purchase inventory at any time during the year? What do we do? At that time, we use a T account, which we call it purchases. So periodically, this is how I remember. Periodically, I go to mall to purchase a shirt. Do I go every day to mall to purchase a shirt? No, I go periodically to mall to purchase a shirt. Periodic purchase, periodic purchase, periodic purchase. Remember that. So under periodic method, we use a T account called purchases. That T account never is used in perpetual method, because in perpetual method we don't need it. We only in perpetual method we always update inventory T account all the time. Recognize the cost of goods sold all the time. The software will do it for us. As soon as we sell something, software will recognize the sales, software will recognize the cost of goods sold, and it will reduce the inventory. So that means inventory gets updated. But in periodic method, we don't have that software. So we are kind of doing it manually. So let's go with this example. On April 10, company orders inventory with an invoice price of $18,000. FOB destination, that means the buyer, MDC, is not paying for it because it's FOB destination. FOB destination, that means seller is paying for the shipping, and seller owns it at time of shipping until it gets to final destination. So MDC receives the goods finally and the invoice on April 13th. So starting April 13th, MDC is the owner, and MDC will recognize this journal entry. Purchase T account will be debited to show that we got some merchandise, and accounts payable will be credited to show the liability. On April 30th, the inventory is sold for $25,000 cash. Okay. So in order to record that, we do this journal entry. So inventory is sold for cash, 25,000. So cash is debited and sales revenue is credited for $25,000. Do we recognize any cost of goods sold? No. We just recognize sales because this is not perpetual method. We only recognize the sales. Okay, so cost of goods sold is not updated. No other account is getting updated. Inventory account still shows last year, December 31st balance. So only thing we recognize when we sell something is just recognition of sales. Prepare the journal entries to record. So one more time, when you buy it, you recognize the purchase. Okay, purchase will be debited, accounts payable will be credited. When you pay for it, then accounts payable will be debited to close the liability, and cash will be credited to show the payment that has been paid. Any moment you sell it, you just recognize debit cash or accounts receivable if it sells on account. If it sells on cash, then record cash debit, and then recognize the revenue. As you see, the inventory T account is not updated, cost of goods sold is not recognized, and it's just periodic. So you might say, okay, where is the cost of goods sold then being recognized? It's at the end of the period, okay? Not right now, end of the period. Okay, so McLean Enterprises orders inventory that lists for $4,000, including $100 for shipping, and it is offered a 10% trade discount. Okay. So the list price is $4,000. Also $100 for shipping and a trade discount of 10%. Trade discount, that means immediate discount. So your list price is not the price you are paying technically. You are paying the list price less 10%. So the list price less 10%, that is where you know that your purchase is $3,600, which is $4,000 minus 10%. Okay. And also remember, because we don't have inventory T account to recognize, we need to recognize that $100 is paid because of shipping, right? So that's a freight in, which at the end will be again added to our cost of the merchandise. So purchase will be debited and freight in will be debited also to show that we paid for shipping because it was FOB shipping point. And accounts payable is $3,700 at this point. Looks like in this scenario, the seller ordered the shipping, but because it's FOB shipping point, the buyer is responsible to pay for that. So the seller ordered the shipping, but added to the invoice. So by end of the day, the buyer pays $3,700, which is $3,600 for the inventory that we purchased and $100 for the shipping. Okay, McLean says that before paying the invoice, McLean says that the half of the units are damaged and returns them. Okay, if half of it is returned, then half of $3,600 inventory is $1,800. So accounts payable will be reduced by doing debit, and you recognize a purchase return of $1,800. Purchase return, it's a contra account. to purchase. Purchase return is a contra account to purchase. So what is net purchase? Net purchase is purchase less purchase returns, less purchase allowances, less purchase discount. That's net purchase. So what is purchase return? Purchase return, that means you physically return the inventory to the seller. What is purchase allowance? Purchase allowance, that means you call seller, you tell him that, you know, this merchandise you sold me doesn't have that much good quality. I'm not happy with it. And they tell you, okay, we're going to give you, you know, $300, let's say, allowance. Pay us less. Are you happy? And then you say, yes, okay, I take that $300 allowance. So it will become purchase allowance. That means you pay less, but you are not returning anything. You are just paying less. So it will become a T account called purchase allowances. What is purchase discount? Purchase discount, it's a discount that you receive if you pay within the payment terms. Let's say the payment terms is 210 net 30. 210 net 30, that means 2% discount if you pay within 10 days. So that 2% discount is your purchase discount. So one more time. What is net purchase? Net purchase equals purchases less purchase returns, less purchase allowance, less purchase discount. That's your net purchase, plus freighting. Got it? So let me do it again. Net purchase equals purchases less purchase returns, less purchase allowances, less purchase discount, plus freighting. That's your net purchase. Okay? If there is no question on this part, we keep going. Sosco, which uses the periodic method, purchases goods with an invoice price of $1,200, and the terms of purchase is 210 net 30. That means 2% discount if paid within 10 days. Otherwise, the net amount total due in 30 days. And pays the net amount after 6 days, which is very good. That means below 10 days. Prepare the journal entries to record the purchase payment if Summit records cash discount. Okay, so add gross. If we want to do add gross, this is how we do it. There's a gross method and net method in accounting. So some accountants, they use gross method. Some accountants, they use net method. Either way is fine. So just let's learn it. If you like to do gross method, then you record the gross amount, which is the total amount of $1,200. So purchase, $1,200 will be debit to record the inventory that you purchased. And accounts payable will be credited to record the liability. However, at the time of payment, the accounts payable will be completely closed, but purchase discount will be recognized for $24. That's saving. And we pay only $11.76. So the $24 is the 2% discount that we saved. So in this situation, what is the net purchase? Net purchase equals purchase less purchase returns, less purchase allowances, less purchase discount. So $1,200 less purchase discount of $24. The net purchase is $11.76, and that's why we exactly pay $11.76. How about net method? If you like net method of accounting and you like to use it this way, it's good because you record the net amount that you eventually will end up with to pay. So your company knows that you always pay within the discount period. So why not? Then recognize purchases for only 1176, which is 1200 minus 2%. And record the liability for 1176. So far, so good. Then your accounts payable department, they see an accounts payable of 1176, and normally you always pay all your bills below 10 days, let's say. So cash will be credited for 1176, exactly as much as the accounts payable is showing, and the journal entry will be very simple journal entry. Because here you have 3 lines of journal entry. That's a compound journal entry, right? But this journal entry is a simple journal entry because it's just 2 lines. It's not compound. Let's do one more problem, number 4. Company which uses the periodic method purchases goods with an invoice price of $3,100 terms, 210 net 30, and pays the full amount after 15 days. Okay, so terms are 210 net 30. That means 2% discount if paid within 10 days. Otherwise, net amount is due in 30 days. Prepare the journal entries. At gross, you go with the whole amount. So purchase $3,100 that will be debited, the gross amount, and accounts payable will be credited. And because it's paid, after 10 days, guess what? There is no discount, right? So accounts payable needs to be paid, and you debit accounts payable and you credit cash for $3,100 to pay it. Okay? Now imagine you do net method. In the net method, first of all, you are sure that you're going to pay within the terms of 10 days. However, you don't, right? In this case, you messed up. So you forgot to pay in 10 days and it gets a little bit complicated. So if you do net method, you say net amount, including discount that I'm going to pay within 10 days, is $3,038, which is $3,100 minus 2%. That's a debit. And accounts payable will be credit. So far, so good. However, you missed that. You missed that 10 days time period. So you end up by paying and closing accounts payable for $3,038, right? That's what you recognized here, right? So you're closing it now. And you're going to send a big check of $3,100. And the difference, it's a plug it in. That means a blank cell that is the difference of 31 minus 3,038, enter. That's $62. That extra money that you need to pay, you record it as purchase discount loss. Purchase discount loss is also a contra account to purchase. It's not a contra account. Technically, it will be added to the purchase at the end of the year. So whatever your purchase is, purchase discount loss will be added to the net purchase. So what would be, one more time, added to the net purchase? Net purchase is purchase minus purchase discount minus purchase returns minus purchase allowances equals net purchase, plus freight in plus purchase discount loss. So this purchase discount loss will be added to purchase down the road to increase the amount of purchase that you did. And technically it was the discount that you lost, but you have to add it to the net purchase. So it's not a contra account to purchase. Technically, it will be added to the purchase. We are good? Okay. Timpani product sells 400 units of inventory for $16,000 on account. On account, that means accounts receivable. So you record sales, credit, accounts receivable, debit. That's sales. Okay. The goods cost Tiffany $18 per unit, which is good, but you're not gonna record it because you don't record the cost of goods sold under periodic method. Remember, if we do periodic method, we just record sales. We don't record the cost of goods sold. So this part that says the good cost $18 doesn't matter that much at this moment. Okay? Before Tiffany receives payment, the customer returns 100 units. Prepare the journal entries to record each transaction. So we record the sales, which is good, for $16,000. But before the payment is received, the customer returns some of it, 100 units. So 100 units times, let's say $40, 16,000 divided by 400, multiplied by $100, that's $4,000 returns. So you record a contra account to sales called sales returns for $4,000, and accounts receivable will be reduced by $4,000. Okay, so what is net sales? Net sales is sales less sales returns, and in this example is 16 minus 4 is $12,000 net sales. So one more time, what is net sales? It's sales minus sales returns minus sales allowance minus sales discount. What is sales allowance? In sales allowance, that means you sold something, but they called you, they complain about the quality or whatever, and you gave them some allowance without anything has been.
You see, I told you.
Without any.
Yeah, I saw it. Yeah, I saw it.
However, sales returns means physically the customer returns some of your inventory. Sales allowance, they didn't return anything. Sales discount, that means you offered your customer at terms like 210 net 30, and the customer took advantage of it, and they paid the invoice within 10 days, and they paid you less. The amount that they paid you less because of that discount, you call it sales discount. So one more time, what is net sales? Net sales is sales minus sales returns minus sales allowance minus sales discount. That is your net sales that goes in the income statement. Okay, if we have no question, let's keep going. Oh, that's it. So that is the periodic method. In the periodic method, I want you also to read the book because it shows how to close the so-called cost of goods, how to recognize the cost of goods sold and close the purchases. So if you read your book, you will see that cost of goods sold needs to be recognized at the end of the period. And all those temporary accounts, which are purchases, they need to be also closed book because those are all temporary accounts. Okay, so purchases normal, like purchase by itself has a debit balance, so it needs to be credited. So purchase needs to be closed. Purchase discount needs to be closed. Purchase allowance needs to be closed. Purchase return needs to be closed. So all those purchases will be closed. The inventory that you had at the beginning January 1st, that needs to be closed also. And the new inventory needs to be recognized. And the cost of goods sold also needs to be recognized. So I'm going to share my camera for a second and show you how that looks like. So here is my camera. And I'm going to pin that. And I'm going to show you this. And also it's in your book, of course, if you like to read that. So you see these are the T accounts that you have. Okay, you have purchases as a debit balance. You have purchase discount that has a credit balance because it's a contra account. You have purchase allowance as a credit balance, it's a contra account. You have purchase discount allowance and purchase returns. So you have purchase returns. Okay, those are all contra account. They need to be closed. Okay. Also, you have what is the other one? Freight in. Freight in is the shipping that you pay for the purchases of the inventory, right? So you have to record that. Okay. What else we need to close? Freight in needs to be closed, purchase discount, purchase allowance, purchase discount lost. Purchase discount lost. Purchase discount lost is the extra money that you pay, just like purchase, because you paid, after the due date and you used net method of accounting. And because of that net method of accounting that you used and you paid after the discount date, so you end up paying extra money, extra interest that you paid, and that's purchase discount lost at that process. Purchase returns are also on the credit side because they are contra account to purchase. Freight in, it's on the debit side because that's extra money you paid for shipping to get the inventory. So purchase, less purchase discount, less purchase allowance, less purchase returns will be net purchase. Net purchase plus freight in plus purchase discount equals total purchase. Make sense? Okay. Anyway, they need to be closed. In order to be closed, you have to, let's say, you have to do what? You have to close the purchase. That's a credit. You have to debit purchase discount. You have to debit purchase allowance. You have to debit purchase returns. You have to do credit purchase discount loss and credit freight in. So how do you do all those? So first of all, you need to recognize the cost of goods sold. Okay. So you need to recognize the cost of goods sold. That's a debit right there. That's a debit. That's a credit, right? You need to recognize the cost of goods sold. And remember the inventory T account, remember, I said that's still January 1st balance. So that inventory needs to update it because still it's showing January 1st. January 1st, that means the balance that came from last year balance sheet of December 31st. Okay. So in order to update all this, the cost of goods sold needs to be debited at the end of the year. So on December 31st, you recognize that cost of goods sold needs to be debited at the end of the year. The inventory that you have on December 31st, the new inventory, the new inventory that you want to have on December 31st, you have to debit that and close the old one. This is the old, right? But the new one needs to be debited. So you debit that new inventory. The same inventory, the old one, needs to be closed. So that is inventory that you need to close. That's a credit. So the inventory needs to be closed. That old inventory needs to be credited to be closed. You see that you credit that inventory. And then you update new inventory. December 31st inventory. You have to debit that and you have to credit that inventory. And then look at all these T accounts in here. You have purchase that needs to be credited. So you have a purchase that needs to be credited to be closed. Okay. You have purchase discount that needs to be debited to be closed. So purchase discount needs to be debited. So purchase discount needs to be debited. Okay, so I'm gonna erase this and bring those stuff a little bit down here. So we can have some room, because remember in accounting we have to do debit first, credit last, right? Debit first, credit last. So here we go. So I need a little bit room here. So purchase discount needs to be debited. Purchase allowance needs to be debited to be closed. So purchase allowance needs to be debited to be closed. Purchase returns needs to be debited to be closed, because you have all these numbers here, right? You have all these numbers and needs to be closed, right? You see that? So all those numbers needs to be closed. So we close purchase allowance, purchase returns needs to be debited. Purchase returns needs to be also debited. So what did we do? We leave the cost of goods sold for now blank. We know what the new inventory is. How do you know what is the new inventory? You do count your inventory on December 31st. You have to close your inventory room, go inside and count it physically. You count it, and that's what your new inventory supposed to be, and that's what you debit that amount, whatever inventory you have. Okay, and purchase discount will be debited to close, allowance will be debited to close, purchase returns will be debited to close, inventory will be credited to close. That's old inventory. Okay, that's last year December 31st inventory. Whatever the balance is, that will be credited to close. And purchase, normal balance is a debit, so you credit that also to close. And in the same time, you see you have freight in here, right? Is a debit. You credit that, and you credit purchase discount loss to close. So those two needs to be also credited. So here, purchase discount loss, that will be also credited, right? Purchase discount loss will be credited, and freight in will be also credited. Freight in, you see that freight in needs to be credited. Okay. So cost of goods sold will be the difference of these four. You don't know what the cost of goods sold is until you add up these four on the credit side, and then minus the others on the debit side, then your cost of goods sold will be equal to that amount. So equals to those four less those four, enter, and that will be your cost of goods sold. So you don't know what the cost of goods sold is until you calculate your count your inventory at the December 31st. So you have that balance available to recognize. Close the old inventory. Close all the purchase discount, purchase allowance, purchase returns. Close the purchases. Recognize, also close the purchase discount loss, if any, and also close the freight in, if any, for the shipping that you paid. And the difference of these four and these four goes into cost of goods. And you journalize that. So this is just one journal entry. Look at how long it is on December 31st. It goes from top, from cost of goods sold on December 31st, all the way debit, 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 credit, 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 and then you click save and you post it to the T accounts. By doing that, purchase T account will be $0. Purchase discount will be $0. Purchase allowance will be $0. Purchase return will be $0. Inventory will get updated because the old will be closed and new will be updated. So purchase will be updated with the inventory will be updated with the new balance of December 31st, right? And purchase discount will be discount loss will be closed, and freight in will be closed. By doing that, all those temporary accounts are closed, inventory is updated, and the cost of goods sold eventually will get updated on December 31st, which is coming from that journal entry into here. Got it? So it's going to be a very long journal entry under periodic method to close all these temporary accounts and record the new inventory and the cost of goods sold T account. Questions? There you go. Okay, so this will be the periodic method of accounting, and I did show you how to do closing entries for periodic method. If you read your book, you will see also there is a full example of that in your book. See you next time for section 4 and 5, which we cover it next time. Have a good day.